Good afternoon.
Hello. How are you?
It's been a rough week, hasn't it?
It sure has.
Yeah.
Yeah. We don't quite have the same pep in our step as usual between, markets, war,
Yeah.
news out of Texas this week really is tugging on my mommy heartstrings and it's making things difficult.
Yeah.
Plus I had a pipe burst under my kitchen floor. So I currently don't have a kitchen in a house with two children. So we're really letting the good times roll over here.
What is going on? It just seemed like we always thought 2020 was the worst possible year, and 2022 is like,
hold my beer.
Bring me back to 2020.
Yeah. Oh, who would have thought we'd say that?
Oh my gosh.
Yeah.
But it's been tough, right? I mean, I have two daughters here this week, and they're all here for Memorial Day, and they have little kids, and they're like, how am I going to take my kids to school? And you just dropped your kids off at school today, right?
Well, I just had to take them on Wednesday, of course. And I burst into tears when I walked away from the kindergarten classroom. Unexpected feelings there, but it's so hard to think that might be the last time you see your kids. It's really weighing heavy on my heart. Today.
I get it.
Yeah. You're having all your kids in town.
I am. Yeah. And it's an annual thing now, and we take pictures, and we have wedding anniversaries to celebrate ours and my daughters. Thank you.
How many years now?
30.
Oh, the big 30.
Big
nice.
30. Yep.
That's wonderful.
Yeah. So
good for you guys.
So we're gonna have a lot of fun. Of course, it's been 93 degrees the last several days, and on the weekend it's going to be 68 or something.
Yeah. Naturally.
Of course, right?
Yeah.
It doesn't work that way. I mean, if you're in Tahoe, it probably would sno. Yeah. Anyway,
that kind of year.
Before we go up to Tahoe and it snows.
Yeah. I would say it's like 50% of the time it rains on Memorial Day. Do not plan your camping trips for Memorial Day.
Yeah.
You always get rained out.
It's really terrible. Yeah. So what are we talking about? I forgot to say welcome to A Place of Possibility. I am Richard Del Monte.
I'm Angela Wright.
And we are happy to have you with us. And what are we talking about today?
So today we're talking about reverse mortgages, which is something I think everybody's heard of. There's a lot of interest and a lot of questions about the topic. Fair amount also of concerns and emotional baggage, disinformation. So to help us sort it all out, we have a wonderful guest today. I'm so excited.
Yeah, me too. Her name is Amanda Keith, and she is a licensed mortgage loan originator specializing in the HUD, Housing and Urban Development Insured Home Equity Conversion Mortgage, also called HECM, and the new jumbo reverse mortgages. With a CPA background that she has, she is a trusted resource for financial professionals, realtors, retirees, and she's also spoken to various professional and industry groups, including financial advisor teams, Cal CPA groups, and realtor associations around the country. She has also been a guest lecturer at Merritt College to their real estate finance class. So please welcome Amanda Keith. Hi, Amanda.
Hi, thanks so much for having me today.
We are thrilled to have you. Thank you so much.
Yeah.
How are you?
I'm great. I just tried out rollerblading a couple days ago on the boardwalk, and
let me see your cast. Let me see your cast.
I didn't fall.
No,
I actually thought about going again this morning, but I was like, I don't want to end up in the hospital when I'm supposed to be doing that podcast.
That's so cool. Yeah. I always see people down, on the Venice Beach area there, and it looks like so much fun.
Yeah, it is a lot of fun. I'm looking forward to getting better at it. So
that's great.
Yeah,
that's great.
And it's a great time to talk about reverse mortgages too, with inflation and people's concerns about spending money from their retirement accounts. I look forward to teaching them more today. Yeah,
absolutely. Yeah, we're getting a lot of questions from our clients, and so I thought we could start with some of the basics for people. So, what is a reverse mortgage? How does it work?
So the easiest way to think of a reverse mortgage, it's a mortgage with deferred repayment. So it's a mortgage specifically created for retirement income purposes for mature Americans.
What age?
It's available to people aged, so there are a couple different products. There are the federally insured loans, like you mentioned, the HECMs, the home equity conversion mortgage. Those are available to borrowers 62 and over. As long as at least one of the couple is 62, then the other one can be considered a non-borrowing spouse. And then the jumbo reverse mortgage product is a proprietary loan, and it's available to borrowers 55 and over. So
55.
55. Yeah, that was recently
Wow.
reduced. It used to be 60, and it's recently gone down to 55. So it opens it up for a lot more people. Yeah.
I can imagine that make people happy and miserable at the same time, because you don't, like, if you're 55, you don't want to think of yourself as a senior citizen,
I
right?
hear you.
Yeah. Remember when they
Mature
started, like,
American. Mature American.
that's true. Yeah.
I like
yeah.
the way you said that instead of senior citizens, mature
Absolutely.
Americans.
I remember when I started turning 50, I started getting letters from AARP, like, to join. Like, what? Are you crazy? I don't want to join you.
Yeah, my
You
fiance
I
is
know.
51.
You love the discount. You hate having that card in your
true.
wallet.
Right. Yeah.
Yeah, my fiance is 51. He said, "Can I get a reverse mortgage in 4 years?" I said, "Hold on, you got to wait for me."
So let's talk about the different kinds of loans that are available. So you have like a lump sum, you can use it to purchase a property, right? And are there like loans that are like HELOCs, kind of that kind of structure? What's available?
Yeah, so there's a fixed rate product which allows borrowers to take a lump sum at closing. So let's say they need all the money at closing to pay off an existing mortgage. So the key to these loans is these liens need to be in first place on the property. So if borrowers currently have a mortgage, that existing mortgage would be refinanced into the reverse mortgage. So let's say that a borrower needs all the loan proceeds to pay off that existing mortgage. They are tired of making a monthly mortgage payment, and they just want to get rid of that cash flow strain. So they can use the fixed rate loan to pay off their existing mortgage, and that way they know the rate. It's fixed for the remainder of their lifetime as long as they live in the home up to age 150. They're protected to stay in the home without ever repaying the debt. Yes, sorry, my light just went out. And they never have to repay the debt as long as they live there. They just need to live in the house, pay their property taxes and homeowners insurance, and maintain the property. So that would be the fixed rate loan if they need all the money up front at closing. And then we have the variable rate product, which has a 5-point lifetime cap on the starting rate. It could never go more than 5 points above the starting rate. And that product can be used as a line of credit. So it's actually better than a HELOC for people in retirement because there's no repayment required as long as they live in the home. So it's a line of credit that can be tapped at any time for any purpose. They can take it in lump sums. Let's say they need a new roof on their house and they need $20,000. They could take that from the line of credit. Or it can be set up in what's called tenure payments, TENURE. So those are guaranteed for life. As up to age 150. So as long as they're living in the house, they can keep getting that guaranteed amount, guaranteed for life. And then there's a term payment. So let's say that they have this line of credit set up and they need care in the home and they know they need $5,000 a month. They could set up to receive that line of credit in recurring payments of $5,000 a month to pay for care, or $10,000, or however much they're needing. So it's really flexible in how the money can be accessed.
Wow.
So are you saying that you could get like the equivalent of a pension from your house?
Yeah, exactly.
Like a
But it's
reverse mortgage that sends you
non-taxable.
a monthly check that's not taxable?
Yes. And since
Wow.
it's proceeds from a loan, it's non-taxable money. That's key, because if people are drawing from retirement accounts and paying tax on that money, not only are they liquidating that asset and losing the ability for future growth on that asset, but they're usually also paying taxes on it. So yes, the reverse mortgage proceeds are all tax-free because they're proceeds from a loan.
Wow.
Wow.
Yeah.
That is super
Pretty interesting.
Well, a lot of people also will sell their house and downsize thinking they need that money. And then you've paid capital gains tax on that potentially.
Exactly.
That's a really good point. You just stay there, right?
Yeah.
Wow, that's
Interesting.
fascinating. I had no idea.
It does give my borrowers the ability to age in place without having to sell, pay those capital gains. So that way, especially if they know they want to live there just for a certain amount of time, they can borrow from the house to pay for their living expenses and then move later if they want to, or move, when a partner passes away or something like that. Wait till there's not such a huge capital gains tax implication.
The more you say about this, the more you keep thinking, it's got to be too good to be true, right? How could this be? I have to pay it back. I get a home equity line, I have to pay it back. We'll get into the payback part.
Is there anything else that a consumer needs to do to qualify? So we've talked about age. We've talked about it has to be in the first position on the home. But is there anything else?
So this loan is available on primary residences. So as long as you're living there as your primary residence, you can look into this loan on single family residences, also on 1 to 4 unit buildings. So even someone who has a duplex or a triplex or a fourplex, as long as they're living in one of the units, they can use this loan to get rid of that mortgage payment, get access to additional equity. Can also be used on townhomes, HUD-approved condos, HUDs, which are planned unit developments. So all of those property types are eligible. They need to be either 55 or older for the jumbo, 62 or older for the HECM, and they need to qualify. So they need to have income to pay their property taxes or homeowners insurance. Or if they don't have that income, we can set aside a portion of the proceeds so that the loan servicer pays that for them. So it's easy to qualify for in retirement. That's why these loans are great.
Yeah.
So it's not like you don't get a credit check or things like that.
We do
Doesn't
pull
really
credit because we do need to look at income versus expenses to see, you know, do you have the money once your expenses are paid to pay your property taxes and homeowners insurance? If you don't, we'll set aside a portion of those proceeds in what's called a life expectancy set aside account. So it's an account, it's money that's earmarked for those future property taxes and insurance. So that way the borrower doesn't have the responsibility of paying them out of their pocket.
But if they were making their property tax payments on time, if someone had like a 500 credit score, they could still get it?
We'd need to look at it. We might need to get an exception for that, but I have recently gotten one approved with an extremely low credit score, yes, because we did set the money aside,
Okay. What about if you know, people, when you're aging in place, at some point, there's a high odds you're going to go into a nursing home or some kind of assisted living. What happens to your house and your mortgage then?
Yeah, so the loan becomes due when a triggering event occurs. So triggering events include sale of the property or someone, the last remaining borrower, once they leave the property, if they have to go into skilled nursing for 12 consecutive months, then the loan comes due. Because the lender feels like if you're out of the house for 12 consecutive months, you're probably not coming back. The house isn't really your primary residence anymore. And since that is the requirement of the loan that you live there as your primary residence, then once you're gone for 12 months, the loan would come due. Also, triggering events include a refinance, transferring title into someone else's name, things like that. So as long as you're living in the house as your primary residence and paying your taxes and insurance and not giving title to someone else or things like that, then the loan is deferred, all repayments deferred.
What if you add a kid to the title and you still are on it?
The HECM loan, you can have a child on title under the age of 62. But again, they do have to sign a document saying that they know that the loan comes due when the parent passes away, because the parent is the borrower. So the child at that time, just like when an heir would inherit a property, the child would need to refinance the debt on the house or sell the house to pay off the debt.
Okay.
Awesome.
So we've been talking about HECMs and then also jumbo reverses. What's the difference between those two generally, you know, those categories of loans?
Yeah, so a HECM can consider a home value up to the FHA max claim amount, which this year is $970,800.
Wow.
So we can determining how much someone can borrow is a calculation. We use their age, interest rates, and the home value. And on average, a borrower can access about 50% of the home value. So if it appraises for $970,000 or more with the HECM, they can access about $450, somewhere in that range. And that's the max available with the HECM. It's based on that $970,800 max claim amount. So with the jumbo reverse mortgage, the actual appraised value is what determines how much they can borrow. So we can loan up to $4 million with a jumbo reverse mortgage. That would be on an $8 or $9 million property, obviously, but we can loan a lot more with the jumbo. The HECM does have lower rates typically, historically, and the jumbo has higher rates. The HECM also has mortgage insurance premium and the jumbo does not. But the biggest difference is that the jumbo can loan a lot more. So if someone owes $1 million on their mortgage and it's a $2 million property and they want to get rid of that mortgage payment, we would be looking at the jumbo for that borrower.
Okay. So today we're looking at mortgage rates, regular traditional mortgage rates at 4.75% to 5% or so. Where are reverse mortgage fixed rates right now?
They're a little higher than that. I believe they're starting, I have an example we can show at the end. I have a fixed rate at 5.99%.
Okay.
The jumbo has different tiers. So the more money you want to borrow, the higher the rate. But I do have an example to show you at 5.99. That's the lowest fixed rate I have today. Yeah.
Okay.
Okay.
Okay, great.
Yeah. What about other, like if somebody is going to get this upfront costs? I've heard people, like in the past, they were higher, and I think a lot of things have changed through the years. What can people expect to see there?
Yeah. So just like any other financial, not sure why that happened.
There we go. We hear you now. We hear you.
Yeah, we're live.
Okay. So just like any other financial tool, there are costs to this loan. And with everything, you have to look at the value proposition. What kind of value is this providing in exchange for this cost? The HECM does have higher costs because there is the mortgage insurance premium that I mentioned. The HECMs are HUD-insured, so HUD charges mortgage insurance premium. And the reason they charge that is because these are non-recourse loans, which means there's no personal liability to repay the debt. Only the house is liable for repayment. So that means if for any reason when the borrower moved out or passed away, if there was a deficiency where the debt was higher than the home value, HUD would cover the difference. So HUD charges for insurance for that feature. There are also lender's origination fees and closing costs. And so the total cost for a HECM can be in the $20,000 to $30,000 range. That's not out of pocket. It gets rolled into the loan. But again, think about the value that that's providing over someone's lifetime. This is something they'll have for the rest of their life if they live in the home for the rest of their life. And not having a mortgage payment, as you know, over 20 or so years, that could be $400,000 or $500,000 that they'll get to keep in their pocket because they're not making their liquid assets illiquid by putting them into their house. The jumbo loans sometimes have lower closing costs. Again, it just depends on the product and how much someone needs to borrow. But we even have some no-cost loans with the jumbos. So,
wow.
Yeah. So It just depends how much they're borrowing.
Are those, you mentioned the word non-recourse for the HECMs, are the jumbos recourse loans, or are they non-recourse?
Good question. They're all non-recourse. It's just that the jumbo lenders, these proprietary loans, they build that extra cost into the rate instead of having a line item for that insurance. Yeah, but they are all non-recourse loans.
And just for our audience's sake, a non-recourse loan means they can't come after you if there's not enough equity in the house at the end of your life to pay the loan off. They can't come after your other assets.
Correct. Yeah. Or your estates. Yeah. If you live in the house. Yeah, exactly.
Right. Yeah. Okay, good. Okay. So you want me to do the next one?
Sure. Yeah. Go for it.
So let's get down to some of the problems that these things can solve, that these mortgages can solve. What do you see, that traditionally where people are using these? And then what are some of the creative ways you've seen them used? I think these are the greatest stories because people don't think about these as a way to solve a problem that they're having.
Right. Right. I wouldn't have thought of it for a monthly income stream.
I know, like replace a pension.
I thought we knew everything.
Yeah. That's pretty cool. Okay.
Yeah. Like you said, like to replace, let's say, well, this is the instance that I helped my mother-in-law use one. Her husband passed away a couple years ago. So their household went from a 2 Social Security income household down to 1. They had a mortgage, so that mortgage payment becomes more difficult when your household income gets cut, in half, effectively. So we were able to eliminate her monthly mortgage payment with this loan and provide her a line of credit of about $120,000, I believe, so that she can, still travel, still go to lunch with her friends, still enjoy her retirement years. So that's the biggest way that my clients use them, is to get rid of that monthly mortgage payment. Like I mentioned earlier, if they're taking money from their retirement accounts or other savings accounts to pay for their mortgage payment or their month-to-month living expenses, this is a good way to avoid drawing from those other accounts, which are often taxable. Another way to use it is as a purchase loan. So many people don't know, and I'm still trying to educate realtors out there too. There aren't just 2 ways to buy a house. People think, I want to downsize. So let's say you have clients that are in or entering retirement and they're thinking about downsizing. you know, they have too many stairs in their house, too much maintenance, they want to be closer to their grandkids. If they sell their existing home and then go to purchase a home, they often think, okay, well, I can pay all cash for my next home. And oftentimes people do, because in retirement, it's hard to qualify for a traditional mortgage. So they end
Sure.
up paying all cash, and, you know, then they don't have much cash to live on oftentimes.
Right.
Or they can look into getting a mortgage, which, you know, many mortgages have a large down payment and then a monthly mortgage payment. And this offers a third option. So a reverse mortgage for purchase has a one-time down payment of approximately 50% of the purchase price, and then the borrowers never have to make any monthly mortgage payments for the rest of their life, as long as they live in the home up to age 150. So that is another unique way to use it. I have a number of clients who need in-home care. As you probably, I'm sure you know, the cost of in-home care is exorbitant. It can be, you know, depending on how much care is needed in the home. I have clients that are paying $4,000 a month for part-time care, up to $15,000 a month for full-time in-home care. So, you know, that burns through a savings account very, very rapidly. So
Sure
if someone
does.
wants to stay in their house, and age in place, they can draw a monthly amount from the reverse mortgage line of credit to pay for that in-home care. So those are the primary ways, you know, I have other people that use the line of credit. Let's say they're drawing too much from their retirement account. Maybe you suggest, or their advisor suggests, that they draw 4% a year from their retirement account, but they're actually drawing 6% a year. So that means, you know, the number one fear of retirees is running out of money. So if they're drawing more than you suggest that they draw, then they could draw that other 2% from the equity in the home instead of continuing to draw it from their retirement account. So that means their retirement accounts will last longer. So those are the primary three ways. And then I have other clients. I had some sisters come to me that inherited a property, and one of the sisters wanted to move into the parents, you know, the house that was inherited, and the other sister wanted the money. So the one sister that wanted to live in the house, and they were 62 or older, so they were looking at the HECM. The sister was looking at the HECM loan. She moved into the house. She got a reverse mortgage to pull cash out. She paid off her other sister, and her other sister was able to take that cash and go buy a house in the location that she wanted. So it can help settle estates and you know, inheritances. Yeah. It can also help people that are going through divorce. If they're old enough to get a reverse mortgage, oftentimes one of them might want to keep the house, the family house. I helped a woman who wanted to stay in the family home. She was able to pull cash out with a reverse mortgage, pay off the husband, and the husband actually took that cash, combined it with a reverse mortgage for purchase, and had his own home. So now, you know, because normally when people get divorced, they think, okay, if I get the house, you know, the other person's going to get the money, and then one person doesn't really have any money, and one person doesn't have a house and might be renting or figuring out how to buy. Yeah, so in this scenario, they were able to actually split the equity. They were each able to end up with the home. Neither one of them had monthly mortgage payments. They didn't have to sell the house, so they didn't have that, you know, worry about having to pay capital gains. They didn't have a real estate commission because they had to sell the family home. They're both homeowners, and they haven't even touched the other savings or asset accounts. So those are, all kinds of ways to use this to problem solve. Yeah.
Did you talk about having this as an emergency fund? Like,
yes.
You know,
so that would, well, no, I didn't, but yes, thank you. The line of credit is the way to have it as an emergency fund. So yeah, I have a lot of clients that, you know, they have just enough income coming in to pay their bills, but what if something happens? What if they need a new roof? What if they have a plumbing issue? What if they have, you know, medical expenses, and they just don't have enough in savings that wouldn't severely impact their you know, way of living. So the line of credit would offer them a safety net. It's a bucket, another bucket of money that's non-taxable, that can be drawn from anytime as needed, that that doesn't have to be paid back in retirement. So it's a great cash flow tool.
Yeah.
That's
And also
awesome.
I can imagine like people that have one of those set up when the markets are down, like right now, they don't want to sell their stocks when they're down. If they have technology stocks, they're down 50%. Who wants to sell those today?
Right.
So you could use
Exactly.
you could use your reverse mortgage and live on that and then pay it back when the markets recover.
Yeah,
right?
don't sell low. It's so
No,
hard for a
it's the last thing
portfolio
you
to
want to do.
recover when you sell low. I actually got an email from a potential client last night saying, my stocks are down. I need to talk to you about this reverse mortgage that I saw you present on a few years ago at the Cal CPA event. So we'll be talking today. Yeah.
Good. We have people that are retired on their younger side, and they wish they had a little bit more money to enjoy themselves. They think, well, when I'm older, I'll probably just not be using as much money. They may not be right about that if they have to go to long-term care, but they think, I wish I could travel now, but I don't have the cash flow.
Yeah.
It seems like that would be a tool to use for that as well.
Yeah, the emergency fund. I mean, it doesn't have to be emergencies. People want to golf more. They want to travel more. They want to be able to go to lunch with their friends and go to the opera and go see the symphony. And, this gives them the ability to really have that retirement that they dreamed about by using the equity. Yeah.
Another idea I've seen in the right situations, these are so creative to some of these options, but for a couple that wants to retire, they're 55 and they can't tap their retirement accounts yet because they have to be 59 and a half. They could now, if they have a jumbo reverse mortgage, they could tap their equity line on their reverse, get through the age 59 and a half, and then use the IRA distributions to pay them back. Right.
Yeah, absolutely. And, you can always make payments towards the reverse mortgage too. That's something people don't realize. You can always make payments towards the loan balance. There are no prepayment penalties. You can even pay it off if you want to. No prepayment penalties, and it just gives them so much more flexibility if they need to bridge the gap. If they want to wait those extra years to start receiving Social Security income, they could use home equity during that time. I don't know if you know, the average American, 78% of Americans hold the majority of their net worth in their home equity.
Sure.
So for most retirees, it is their largest asset. So if you think about it, it's another bucket that, this helps them monetize that. It gives them the ability to leverage that home equity instead of drawing from other accounts. So it can be used strategically along with you. Y'all can determine, should I pull money from this account or this account this year? The markets are down. Don't pull from your investments, pull from this year. So yeah, just having a line of credit that you can use for anything you want or need, it's a game changer.
Yep. And people, a lot of times they want to help their kids buy houses, especially now when prices are so insane. I mean, I can imagine they could take a chunk out of their home and give it to the kids to be able to buy a house, right? Or put a down payment on the house and they own that piece. They could do a shared equity situation like we have talked about before.
Absolutely. Yeah. And you can also draw from let's say someone wants to buy a vacation property up in, Sierra Nevadas or something like that. They could take a lump sum payment out of their house through the reverse mortgage and go buy that vacation home. So now they've got two homes that they don't have mortgage payments on, that they're able to enjoy throughout their retirement and that are appreciating. These are, appreciating assets. So
So
too good to be true.
No, well, you brought up something interesting, that this is for 78% of people, this is their largest asset. And I think that's kind of ties into a question that I had, like, we're all taught that all debt is bad and we should pay off our debt. And you definitely have to pay off your mortgage before you retire. And I was wondering if you could speak to some of those, the bad rap things, right? Like that it's bad debt, or that, children are fearful that they'll lose their inheritance when mom and dad die if they do this, or that mom and dad will lose the house or something like that.
And that's the elephant in the room. We're going to lose our inheritance. Right?
Yeah. So what do you think about that?
And oftentimes there have been a lot of academicians doing studies on reverse mortgages that have found that using a reverse mortgage strategically during retirement can actually help someone leave a larger legacy. Because, like we mentioned, if you're strategically using one asset over another one that's costing you more, you're going to leave more money behind. You need to use the money that's costing you the less, that has the least, negative impacts. So don't use assets that are going to, be used up and have to have taxes owed on them if you can use an asset that's going to continue appreciating, like the home, and will continue to serve you throughout your life. If you liquidate, liquid assets, those aren't going to continue to serve you. Whereas the house, if you use the equity, it will continue to serve you during your lifetime. So I think once the heirs really understand it, that this, the parents stay on title, the borrowers stay on title. They have the right and the ability to sell the house at any time. A lot of people think that, oh, if I get a reverse mortgage, I have to live in that house the rest of my life. Absolutely not. That's not the case. You can sell the house at any time. You just pay back the money that you borrowed with the interest that accrued, and all the rest of the equity is the borrower's. When they sell the house, the equity is always theirs. And if the heirs inherit it, same thing. They can either sell the house to pay off their parents' reverse mortgage, and the equity goes to the heirs, or they can refinance that debt and keep the house if they want to. So I think it's really just a lack of education, typically, is what leads to so much fear. In the 80s and 90s, there was a product that was called a reverse annuity mortgage, and those were sold by annuity companies. They had extremely high interest rates. The annuity company, upon loaning that money, required that the borrowers purchase an annuity from them. And then at the end, when the borrower moved out or passed away, the annuity company also got half the appreciation that occurred during those loan terms. So those were called, those were called RAMs, reverse annuity mortgages. Those are no longer in existence. Yeah, today's reverse mortgages. That's a good point. Today's reverse mortgages are much more reasonable. They're created specifically for these people to age in place and utilize their largest asset.
Okay, so the kids don't have to worry that the lender's going to take their house.
No, they don't. Right? As long as their parents are living there as their primary residence, paying their property charges, so property taxes, homeowners insurance, HOA dues if they're applicable. The borrowers need to keep the house maintained up to health and safety standards, and that's it. Live there, pay your property charges, maintain the property, and you're in good standing with the loan up to age 150.
We have an example, I think, that you prepared for us that we could show that kind of shows what happens to the loan balance if you get one of these, and what happens to your equity. Can we get that up?
So while we're pulling it up, go ahead, Amanda. I was going to say what it is.
Maybe just tell us what happens at in the beginning, what a house is worth, and then the loan, and then what happens in 10 years and maybe 20 years.
Yeah, so
it's
here I've got, it is, absolutely.
It is small, but we'll put it in the show notes. And if you're listening to this, of course, it's right there in the show notes for you to pull up and reference.
Great. So this is this is actually a 70-year-old borrower with about a $1.36 million appraised value on their property. And this person has a $500,000 mortgage balance. So they're making big payments every month towards their mortgage. I don't know where they're getting the money to make those. Maybe it's all their Social Security income and their pension income. Maybe their Social Security and pension income isn't enough and they're having to draw from taxable accounts to make that mortgage payment. Nonetheless, they're tired of paying it and they want to get rid of it. So we are able to refinance that $500,000 mortgage into the reverse mortgage. All their monthly mortgage payments go away. And what I wanted to show here is so let's say they get the loan at 70 and they live in the house for another 20 years. And after 20 years, either maybe they pass away or maybe they decide to sell and go into a senior care home. So in year 20, their home would have appreciated. So we're assuming a 4% appreciation. And I build these amortization schedules all the time. In California, 4% appreciation over time is very conservative, actually. So in 20 years, their home would have increased from about 1.36 to about almost $3 million. That loan, it does grow over time, so they'd have about a $1.7 million loan balance. So their equity in 20 years sits at about $1.3 million. So when they started the loan, keep in mind, the house value was 1.36. They borrowed 500. So when they got the loan, they had equity of 867,000 when they got the reverse mortgage. So that equity is actually rising with their property value increasing at 4% a year. The equity is going up faster than the loan balance is growing. This is a 5.99% fixed rate jumbo loan, and their equity is actually exceeding the growth on their loan balance. So in 20 years, they could sell and pay off the reverse mortgage and still have about 1.3 million. So as far as the heirs go, that's not too shabby a number. It's definitely that would be, something nice to inherit for sure.
Yeah. So
Right.
back off, kids. Your mom, let mom and dad have a good time. You're still going to get more money,
Yeah.
right?
Yeah.
Yeah.
It's a good
Awesome. That's great.
example.
So what should people be aware of when they're thinking about getting a reverse mortgage?
So,
what are the concerns? What are the caveats, the things you should, that are maybe things to avoid?
Yeah. So if you're looking to sell within the next, couple years, it might not make the most sense. It just depends on what you need the money for. If you're looking to sell that fast, because there are closing costs with the HECM, they're higher, like I mentioned. There are closing costs to get this loan. So when we talked about the value proposition of the closing cost, what value will you be receiving from it if you're going to sell within the next couple of years? Another thing to think about is if you're Airbnb a part of your house, the lender does not allow you to use your property for short-term rentals. You are absolutely able to rent out a room to somebody on a longer term basis, but they don't want you running a business out of your house and using your house for Airbnb and VRBO and things like that. So those are the two primary concerns that I see. And if your kids need to talk about it, any reputable loan officer that's providing reverse mortgages should be willing to talk with you and your family, any of your advisors, and make sure that everyone's educated and on the same page.
Great advice. Well, Amanda, thank you very much for being our guest today. We really appreciate it. It's been very informative.
Yes.
Thank
You're
you
a great
for having
guest.
me.
And thank you.
So much great information. And if somebody wants to inquire with you about a reverse mortgage, what should they do? How do they reach out?
Yeah, so you can reach me at the number on the screen. That's my mobile number, 415-747-5668. I also have a really easy to remember phone number, which is 510-REVERSE, REVERSE, and that comes straight to my mobile phone as well. Or you can email me at akeith, that's KEITH, at mutualmortgage.com. Or you can even text me at that number on the screen as well, that 415-747-5668. I respond quickly and I love to help.
Yes,
I love to empower people to, have a sustainable retirement. So.
Wonderful.
Awesome.
Wonderful.
Thank you
again
so much for being
Thank
here.
you for having me. I love your podcasts. I've been watching them. All right.
Thank you so much. We're glad you like them.
Have
See
a
you
great
soon.
day.
Bye-bye.
Thanks. Bye.
Wow.
Okay.
So many great questions answered.
Yeah, for sure. For sure.
I love it.
So we have our little our closing reminders.
Of
right?
course we do. Yeah. So thank you so much, everybody, for joining us today. As always, if you want a copy of Endless Inheritance, please go ahead and request one using the link on your screen or on our website, free to you. This is about family dynamics and transferring that wealth to your heirs. So if that's on your mind after today, definitely pick up a copy of this. If you have any questions, or topic requests, you can send them to us at info@aplaceofpossibility.com. Of course, you can always schedule a meeting to talk with one or both of us if you want some financial support. Click on the link on your screen or go to aplaceofpossibility.com, and we will see you next time. Thanks for being here.
Yep. And I think next time, are we doing college planning?
I think so.
I think we're going to finally do college planning. We keep getting put off by
it's been on the docket, but all this current events. Yeah.
So anyway, well, thank you very much for being here. We appreciate it. And don't forget, you're invested and so are we.